Joining us now, Gartman letter editor and publisher Dennis Gartman. He's been publishing his daily commentary on global capital markets since 1987. First of all, welcome. Great to have you on the show. Great to have you on today. And how interesting that you've been doing it since 1987. That was another time when stocks had a much worse. Stocks actually crashed. What's the difference between then and now?
I think, first of all, we have to remember that in October of '87, we did go down almost 24%, if I can remember correctly, between October 19th and October 21st. Here we're down only 4.5% or 5%. Actually, I think we got at one point today down 10% from the highs. It's a far more mature market than it was back then. I think the fact that we have better derivatives to arbitrage than we did back then. We understand a little bit better some of the problems that can be incumbent in the derivatives markets. I think we also have better news services, and so we have a better dissemination of news and probably a better understanding of it. I think we are far more mature than we were then. Nonetheless, I think we have some difficulties ahead, and I think that the past couple days are only the beginning of what could be still a substantive bear market in stocks that I think has begun.
A substantive bear market in stocks. So you're looking for something much bigger than we've seen the last couple of days. Remind us, how do we define a bear market? How substantive will it get?
Well, I think, first of all, everybody wants to say that I'm amused when people think you can go down 10% and that's when you start the beginnings of a bear market. To me, anytime you're down more than 5 or 7%, that's a fairly substantive hit to one's equity. I wouldn't be surprised, however, if we take this one after having had a bull market that began in, 2009 at 666, an auspicious number to say the least on the S&P, and it's been 9 years of a bull market. Can we give back 12, 15, 17% over the course of the next several months? It would not surprise me at all. In fact, I'd be somewhat surprised if we didn't do that.
What's going to drive it? Is it just the momentum? Is it just the technical aspect? People wanting to get ahead of the decline, fear, panic. Is there something fundamentally different now, Dennis, that would justify this?
Well, first of all, stock prices became egregiously overbought. I mean, the public became enamored of shares beginning in November of all times, started to become even more enamored of shares in December, threw in dramatically in January, and the public is always late. Two, we have the beginnings, I think, of inflation. I think that 2.9% wage increase that was reported last month is just the start of something. When you travel around the country and ask businessmen what's their biggest concern, their biggest concern is they can't find labor. Labor costs are beginning to rise. Commodity prices, I think, have seen their lows and are beginning to turn higher. And I think that I put a lot of credence in what goes on in international trade. I think we made a terrible decision here in the United States imposing trade tariffs upon washing machines and solar panels. Now the Chinese over the weekend have imposed trade tariffs on grain that we export to them. It's a tit-for-tat sort of circumstance, and that bothers me greatly. So I think there's a number of things that are worrisome at this point that people are not taking enough into consideration.
So do you agree with an earlier guess that the big risk to stocks this year, besides all the ones you just listed, and I think that the trade aspect cannot be overlooked because many experts on China are saying this is the year when the trade war that didn't happen in 2017 is going to happen. But the biggest possible threat being the Fed getting it wrong, raising rates too much. Do you agree with that?
I think the Fed will probably get it wrong. The Fed historically has gotten things wrong. Now, I have great respect for Mr. Powell. I think he'll do a fine job. He's far more moderate in his policies. But nonetheless, I think the Fed probably shall raise rates 4 times this year, probably 25 basis points each time. We won't. I hope that we don't move the Fed too much and take it and move the curve to an inversion. But certainly we're going to take rates at least another 100 basis points at the short end higher and maybe 50 to 75 basis points higher at the long end. That suddenly makes bonds at the long end of the curve an investment vehicle and competitive with equities prices. So I think we have some problems here, Kathleen.
All righty. Really quick question, but it does have 2 parts. Yeah. How low is the 10-year yield, or how high is it going to go? And what do you buy now? One thing you should buy if you should get out of stocks, because what you're saying.
First of all, I think you should be reducing your position in stocks rather dramatically. One thing I would buy, commodities. I think commodity prices in balance compared to equities prices are ridiculously inexpensive. If I could only buy one thing, I probably would be a buyer of wheat. I know that's hard for most people to do that, but there are ETFs that let you take that, to do that, put that trade into effect. And how far do I think the 10-year can go? You have to remember, you and I both, we're from our old days in Chicago 25 years ago when we remember the long bond with a 14% coupon. Can I imagine the 10-year with a 4% coupon in the course of the next 6 months to a year? Yes, I can imagine the 10-year with a 4% coupon. By historical terms, that would not be unusual.